You need money to start, run, or expand your business. Even with good staff and good products to sell, this can be challenging, particularly when you're first starting out. Business finance, the setup and controlling of possessions by business organizations. In simpler terms, business finance can be defined as the provision of money at the time when a business needs it. Financial managers are responsible for the planning, analysis, and control operations of a firm. And they are quite close to the top of the organization. Accounting path and coordinate your company's monetary report. So business finance uses these reports to assist you in managing your money. In order to make your whole operation more profitable. Business finance includes these following. Reading financial statements, connecting the dots between your profit and loss, balance sheet, and cash flow statements. If these records point to a capital deficit, business finance also presents the mechanism to arrange a scheme to merge the gap. Finance is the basic of business. It is compulsory in a firm and other to acquire assets, goods, resources, and of course other flow of industrial activities. Every business needs capital. Capital is required at the time of the beginning of the business. It is also needed when the business is in operation. As a business increases in size and spreads, so does financing need to be in place. The capital requirements for the business are divided into two classes called fixed capital and working capital. What is fixed capital? As far as economics and accounting are concerned, fixed capital is any kind of substantial asset that is used regularly in the manufacturing of a product. It contrasts with rotating capital such as managing expenses, raw materials, and the like. It is obligated for every business to have a sufficient amount of fixed capital before it starts operating. As the name indicated, the amount of capital invested in various fixed or permanent assets, which are necessary for conducting the operation of a business, is known as fixed capital. Fixed assets are tangible assets that cannot be converted into cash easily. Examples of fixed assets include property, plants, equipment. We do not resell fixed assets as part of our everyday business operations. Hence, fixed assets are used in the production of a company's income and administrative ambitions. The fixed assets normally do not change their form and cannot be withdrawn from the business at short notice. Some people use the terms of fixed assets, capital interchangeably. However, when the term capital is used, it is referred to as the money we invest in fixed assets. They can, however, be disposed of. Fixed capitals thus are the funds required for the purchase of those assets that are to be used over and over for a long period of time in business. Investments in non-current assets such as goodwill, patent rights, copyrights, long-term receivables, also form a part of fixed assets. The amount of capital required for investment in fixed assets varies with size, nature, and method of production of the business. Large-scale industries, like railways, oil drilling operations, hydro and thermal electricity projects, required more fixed capital. Fixed capital contains fixed assets and other non-current assets. The usefulness of fixed capital can be considered from the law that states a business can't operate without it. Right from the very beginning, i.e., realize that an idea of business need, purchasing of land, construction of a building, purchasing machinery, etc. Further, for the expansion and modernization of machinery also fixed capital is required. So it is essential to have an adequate amount of fixed capital in an enterprise. What is working capital? Working capital is popularly known as net working capital, NWC. NWC is the difference between a company's current assets, such as cash, accounts receivable, customers' unpaid bills, inventories of raw materials, finished goods, and its present debts, such as accounts payable. Net running working capital is a quota of a company's liquidity and points out the difference between running current assets and running current liabilities. In many cases, these calculations are the same and are derived from company cash plus accounts receivable plus inventories, fewer accounts payable, and fewer accrued expenses. Working capital is a part of a company's liquidity, practical efficiency, and short-term financial health. Suppose a company has considerable working capital, then it is possible for the company to grow and invest. If the current assets do not outdo the current liabilities, the company will issue with growth or even paying back creditors, and can even go bankrupt. Working capital, also called circulating capital, which is the lifeblood and nerve center of business. Working capital is mostly used for the purchase of 1. Raw material. 2. Payment of wages. 3. Seasonal urgent demands of the business. 4. Purchase of more goods for sale. 5. Meeting the expenses of advertising. 6. Providing credit facilities to the customers, etc. Here is a formula to calculate working capital. Current assets, current liabilities equals working capital. Let's say, for example, if you have $5 million as your current asset and $3 million as your current liabilities. Subtracting those as the formula suggested will give the net working capital of $2 million. If the difference between the current assets and current liabilities is positive, that means the company has a surplus working capital. But on the other hand, if the result is negative, that means the company has deficient working capital. What are the importances of working capital? Working capital is a crucial part of a business and it can produce the following advantages. 1. Solvency of business. It helps the insolvency of the business. The flow of production remains uninterrupted. 2. Goodwill. The managers will able to pay wages to the workers and clear other bills in time. This act helps in creating goodwill for a company. 3. Loans on favorable terms. A business with high solvency and greater goodwill can easily obtain loans from banks. 4. Cash discounts. A business with adequate working capital can obtain cash discounts on purchases. This helps in reducing costs. 5. Enables to face a crisis. Adequate working capital enables an enterprise to face a business crisis. 6. Regular payment of dividend. A sufficient amount of working capital enables a business to earn profit and pay a dividend to investors in time. That's it, guys. Let us know in the comment section below if you like this video. As always, don't forget to subscribe for more amazing topics. And turn on the notification bell, so you will be the first to know when we drop another video, and thanks for watching.